Welcome back, Focus Learners, to today's Daily Brief Explainer. We've got something completely unexpected cooking in the financial markets today. Right now, almost everyone is totally fixated on the big technology companies driving the artificial intelligence revolution, right? But if we actually look at the data, there's a highly traditional, honestly kind of boring sector that is quietly cashing in on this massive AI boom. We're going to pull back the curtain on the market mechanics today and reveal exactly where the smart money is positioning itself.
Okay, let's dive into this. When you hear AI, your mind probably jumps straight to those flashy microchip manufacturers or the massive software conglomerates. And hey, that's where all the retail hype is concentrated right now, for sure. But if we look purely at the mechanics of the market, the real underlying beneficiaries aren't always the ones making the front page headlines. We really need to challenge this assumption that only the flashy tech giants are reaping the financial rewards of this massive technological leap. Just consider the landscape for a second. On one side, you've got your high-volatility tech stocks. Sure, they're thrilling, but let's be honest, those violent swings and deep drawdowns, they're enough to give you heart palpitations. They're heavily chased by novice investors who are just looking to get rich quick. But then on the other side, you have the calculated, incredibly stable approach of traditional large U.S. banks. Now, they might not be the most glamorous assets in your portfolio, but as the data clearly reveals, they offer a fundamentally sound way to ride the AI wave without that heart-stopping volatility.
To really understand this, we're going to follow a very clear, methodical path today. 1. The hidden AI beneficiaries. 2. Macro tailwinds for banks. 3. Filtering the financial ETFs. 4. Reading the technical breakout. And finally, number 5, the correction strategy. We are moving methodically from broad macroeconomic trends right down to a precise, actionable strategy.
All right, let's start with Section 1, Macro Tailwinds for Banks, the top-down view.
Now, before we even think about diving into specific tickers, we need a solid institutional framework. The data points to a really fascinating institutional concept. The broad trend of a sector and its industry explains roughly 50% of a stock's price action. Literally, half of your trade success comes down to just being in the right neighborhood. A buy signal in a strong sector has a massively higher probability of success than that exact same signal in a weak one. So, our very first step is to align ourselves with the broad bullish trends of the S&P 500 and the NASDAQ, and then we actively hunt for sectors backed by concrete macroeconomic tailwinds.
Which brings us directly to this really powerful number right here, 2.7%. The New York Federal Reserve currently estimates that the U.S. economy is growing at a strong rate of 2.7%. Now, why does that matter? Well, in the current economic climate, that kind of robust growth is a fundamental prerequisite for large financial institutions to truly thrive. The economy is expanding, which means capital is actively flowing, and that creates the absolute perfect environment for these banks to operate at peak capacity.
On top of that, we're currently seeing a positive yield curve, which is simply when the 10-year Treasury yield is greater than the 2-year yield. When you pair this with clean credit quality across major institutions and tightly controlled liability costs, a positive yield curve acts as a massive structural tailwind for the major banks. Think about it. They borrow short and they lend long. So when the yield curve is positive, that core business model becomes exceptionally profitable.
Moving on to Section 2. The hidden AI beneficiaries. How banks profit.
So the macro picture for banks is looking incredibly strong right now. But here's the core paradox of today's explainer. How on earth are these traditional, centuries-old banking institutions actually monetizing the cutting-edge AI revolution? Well, they're doing it across multiple, highly lucrative fronts. First up, through broad tech lending. They are the ones actually underwriting the massive capital expenditures required to build all this new AI infrastructure. Second, through massive IPO commissions. When giants like SpaceX, or AI leaders like Anthropic, or even those massive secondary offerings from Google and Meta hit the market, guess who's collecting the underwriting fees? The large U.S. banks. And third, they are utilizing AI directly to drastically improve their own internal back-end productivity while simultaneously positioning themselves to profit from the absolute explosion in the stablecoin market.
Let's jump to Section 3, Filtering the Financial ETFs, Finding the Right Vehicle.
Okay, so we've got the fundamental thesis down. Large U.S. banks are a highly attractive, lower volatility AI play. But how do we actually trade this trend? Filtering out the noise is absolutely key here. Broad financial funds like XLF are just too diluted. They include insurance and a bunch of other broad financials, which completely waters down our specific bank thesis. Regional funds like KBE, they carry entirely different risks and they're just far too narrow. And this brilliantly illustrates why the optimal target the data points to is KBW. It's an ETF that perfectly isolates those large Tier 1 U.S. banks like Goldman Sachs and Morgan Stanley.
Now, just a really quick note for our European-focused learners. Because of regulatory protections, retail investors in Europe often can't just go out and buy US-domiciled ETFs directly, and that's exactly where USITS comes in. It's basically a regulatory framework that ensures funds meet strict safety and transparency standards. So the USITS-compliant European equivalent for this exact trade is the ticker BNKS. It perfectly mirrors our optimal target, so you have a specific, compliant tool ready to go.
All right, Section 4, reading the technical breakout, the institutional wall.
So we have the macro thesis and we have our exact ticker. Now let's drop down into the micro-level technical charts to translate these complex market mechanics into some really simple visual concepts. There is this fascinating story around the 88 level on the KBWB chart. For the longest time, that 88 level acted as a massive wall of resistance. Basically, there was a heavy concentration of call options sitting right there, acting as an artificial ceiling for the price. It took 3 or 4 really aggressive attempts, but in mid-May, the underlying market strength violently shattered that wall, pushing the price cleanly above it.
Now, because of that huge breakout, the ETF has been climbing steadily and is now officially in overbought territory. Think about it. Everyone who wanted to buy the breakout has already bought in, and this creates a highly dangerous environment for retail traders, largely because of a practice called stop-loss hunting. This is an incredibly common maneuver where larger players deliberately push the market down to trigger a bunch of automatic sell orders. This causes a rapid cascade of selling, allowing them to just sweep up all that liquidity at a discount. Retail investors are prime targets for this right now.
Right now, based on market mechanics, the absolute danger zone sits at exactly 91.91. If the price slips below that 91.91 mark, retail traders who are currently sitting on some really comfortable profits are absolutely going to panic. Their stop losses are heavily clustered right at that exact level, just waiting to be hunted. If that level breaks, it's highly likely to trigger a rapid, self-fulfilling cascade of selling.
Which leads us nicely into Section 5, the correction strategy, patience, and precision. This brings us to our final tactical blueprint. Look, we know the fundamental value is there, but the technical suggests it's currently a really dangerous place to deploy your capital. The data clearly shows that jumping into an overbought market right now is just a rookie mistake. The smart money approach is having the discipline to say, I am waiting for a correction to find a point with an adequate risk-reward ratio. So the crucial point is that you want to avoid buying at the very top only to immediately suffer a painful 5% drawdown. Smart money waits.
So instead of chasing the high, the institutional approach is to set a trap of their own. They wait patiently for what we call the sniper zone. When that retail stop-loss hunt inevitably happens and the price drops rapidly, the data suggests looking for an entry point right between the 8,800 and 8,930 support levels. Remember that massive resistance wall at 88 we just talked about? Well, in technical analysis, old resistance almost always becomes the new structural floor. That's your sweet spot.
But listen to me carefully, because the source material emphasizes one critical rule above absolutely everything else. Always use a strict stop-loss to protect your capital. I mean it. No matter how perfect a macro thesis is, no matter how incredibly clean the technical setup looks, surviving the financial markets requires absolute, unwavering discipline. If the ETF drops cleanly below that 88 support, the thesis is temporarily invalidated, and you absolutely must cut your losses to protect your capital.
We've covered a lot today, moving from the broad macroeconomic growth of the U.S. to the hidden ways large banks are profiting from AI, right down to the exact technical levels where the smart money is waiting to pounce. But here is the reality. The market mechanics are currently setting up a massive trap for impatient retail traders at the very top. The data and the strategy are perfectly clear, but the ultimate question is this: are you disciplined enough to sit on your hands and wait for the drop? Think about your own trading psychology on that one, and we'll see you on the next Daily Brief Explainer.